Welcome to another edition of the Fans Week podcast, also on medium waves 1575 kilohertz. From Paris, I'm Amy Carter Wilson, understanding oil and gas price dynamics via futures and CDS. By Amy Carter Wilson, article to be published on the Wall Street Journal on April 22, 2026. In finance, futures are standardized contracts that obligate two parties to buy or sell an asset at a set price on a specific future date, and they're often used to hedge risk or speculate on price moves. CDS usually means a credit default swap, which is a contract that acts like insurance against a borrower defaulting. The buyer pays a fee, and the seller pays out if a credit event happens. I'm talking about them today as they are useful tools to understand oil and gas price dynamics, and in simple terms, can tell us how much our gas, petrol, or the fuel we put into our cars will cost in the future. The term structure of energy commodity derivatives, specifically, the interplay between physical futures basis convergence dynamics and credit default swap, CDS implied probability of default surfaces, constitutes one of the most structurally underappreciated frontiers in global macroeconomic risk pricing. This note dissects the transmission channels through which forward curve morphology in crude, Brent, WTI, and natural gas, Henry Hub, TTF, NBP futures, co-evolves with sovereign and counterparty CDS spread trajectories, thereby encoding embedded optionality that traditional spot-based fundamental models systematically misprice. The foundational insight traces to Myron Scholes, 2000, seminal reformulation of commodity option pricing under stochastic basis risk, later extended by John C. Cox, Mark Rubenstein, and the Cambridge Energy Economics Group at Cambridge University's Energy Policy Research Group, EPRG. More recently, the work of Robert Pindyck on real options in extractive industries, Pindyck 1988, irreversible costs, capacity selection, and the value of the corporation, Restat, articulates how stochastic supply disruptions, geopolitical, climatic, or infrastructural, imprint convexity humps onto near-month futures that CDS markets price as tail risk premiums. The synthesis, oil and gas futures curves, are not merely forward price expectations. They are living probability distributions encoding both physical market frictions and credit risk sentiment. Consider the mechanics. A steep backwardation on front-month Brent, e.g., $63 to $68 per barrel, with a minus 2% MOM term spread into the next year's strip, signals tight, near-term physical scarcity. In efficient markets, this backwardation should correlate negatively with CDS spreads on mid-tier EPC contractors and sovereigns exposed to hydrocarbon revenues, Qatar Energy, Nigeria, Norway's fiscal balance. Conversely, in contango, wherein the far month strip trades at a 3 to 5% premium over spot, producers face margin compression that increases counterparty delinquency risk, widening CDS on counterparties with significant commodity-linked book exposure. The CDS curve thus acts as an independent verification layer on whether backwardation is real, demand-supply driven, or phantom, speculative positioning, inventory drawdowns. This duality was first formalized by Gibson and Schwartz, 1990, in their two-factor spot futures model, later refined by Schwartz and Smith's, 2000, mean reverting secondary factor. The CDS side of the equation, where one values contingent claims on hydrocarbon sector credit events, imports structural dependencies from the Jarrow-Turnbull, 1995, reduced form framework, and Duffy and Singleton's, 1999, modeling of counterparty risk in OTC derivatives. Applied to oil and gas, CDS spreads on majors, Shell, Total Energies, Equinor, and LNG shipping names, Frontline, Golar LNG, embed the market's assessment of I. Realized volatility in underlying commodity prices, 2. Leverage ratios on commodity-linked balance sheets, and 2. Sovereign risk transmission through fiscal oil break-even thresholds. As Acharya and Richard, 1989, demonstrated in their work on structural credit models, the option value of default rises non-linearly with commodity price variance, meaning a 10% move in Brent generates disproportionately larger CDS widening than its linear beta would imply. At the microstructure level, the interaction between E-mini crude futures margin cycles and CDS auction outcomes, regular and special, reveals regime shifts. Prior to the August 2007 subprime credit event, Breen et al. 1996 showed that risk-neutral densities extracted from options markets dominated fundamental spot dynamics. In energy, this translates to the risk-neutral slope of the futures curve deviating from the physical forward curve via the commodity risk premium. Cochrane, 2015. The Finance Cookbook. When CDS spreads widen beyond the historical bandwidth implied by Brent volume, the Basel III Standardized Approach Formula, BCBS 2019, one should interpret this as a market signal. Speculators are positioning for supply disruption or demand destruction that spot fundamentals alone cannot capture. This framework has policy implications of staggering magnitude. The IEA's Strategic Petroleum Reserve Release Mechanics, calibrated to EIA inventory data and benchmark future spread thresholds, interact non-trivially with CDS secondary markets on Gulf Cooperation Council, GCC sovereigns. A collapse in the Brent December strip below $70 per barrel, coupled with a 40-plus BPS widening in Saudi Arabia 5-year CDS, would signal not merely a price correction, but a regime transition in global hydrocarbon pricing architecture. As argued by Huntington, 2008, and later by the OPEC Secretariat's own internal modeling documents, Leach 2016, these dynamics remain structurally underweight in IMF Article 4 consultations in G7 macroprudential stress tests. In sum, oil and gas price formation is no longer a single-factor story driven by spot supply elasticities or OPEC plus quota adherence. It is a multi-dimensional surface wherein futures term structure morphology, CDS implied default probabilities, and stochastic volatility clustering converge to encode regime-dependent pricing. Any macroeconomic model that treats energy commodities as exogenous input costs rather than endogenously priced risk transfer vehicles with deep derivatives markets is structurally obsolete. The question for policymakers and investors alike is no longer, what will Brent do next? But what does the joint distribution of futures term structure and CDS spread dynamics say about systemic fragility? That's all from today. From Paris, I'm Amy Carter Wilson.